logging on now to YouTube. So make sure you connect with me on there because I'm not going to guarantee that this stream will stay consistent. And I am going to do my best to record everything. So I have a very unique setup here. I have like three cameras going, which is hilarious. This is the most cameras I ever had going at one time. Hi, y'all. So I am going to, let's see if I can go ahead and go to my YouTube. It's in my bio. In bio, it's the first link. I try to put it up top for y'all so that way you can make sure you get to see all of this. I'm gonna pin it here. I will try to keep this open as I get started. And like I said, the YouTube Live is going to be kind of the main area that I want to do this on because it's going to be a lot easier. So, all right, if you are on my Instagram, again, just try to double check and go to YouTube because I don't know, this one sometimes taps out and all kind of ghetto stuff. So, we'll probably start in like 2 minutes. How are y'all doing? So, if you do not know me, my name is Kenesia LeBlanc. I'm here in Atlanta, Georgia, and I am a real estate agent. I've been a real estate agent for going on 4.5 years. It's so crazy to even say that. It's a blessing to say that, to say the least. And let me move the camera around, y'all, to this way. So that way we are on the same kind of vibe. So I need to make sure all the cameras are set up like in the same setup, which is so crazy. Because I have three cameras here, so everyone needs to be on the same. So, again, I am a real estate agent here. I have worked with almost a little bit over 50 or close to about 50 families in the Atlanta metro, as well as Tampa, Florida, where I'm originally from. I'm a University of South Florida grad. I am also a individual who has worked in finance, corporate finance before. So the information that I try to give my clients and to anybody else is all based off of my experience, you guys. I try not to give fluff information. I try not to give BS. So on this live, I wanted to make sure that I was able to give you guys just information that is up to date. So anytime I do a seminar, it's going to be information that is relevant to the market today. It's going to be information that is going to be helpful for you, no matter if you are looking to be a home buyer, investor, or if you're looking to just get into real estate in a passive way. That's what this is for. So, like I said, thank you so much for joining the YouTube. Thank you for joining on Instagram. But we are going to go ahead and get started. It's not going to, I'm not one to talk all day, y'all. So I like to get straight to the point. So that's exactly what we're going to do. So hopefully y'all can hear me well. Give me some thumbs up. Let me know if you can't hear me because we're about to get started. All right. So, of course, I got some notes here so that way I don't get on my tangents and just start talking away. And usually I have a little tequila, but this time we're going to keep it straight to the point. So, the first thing, of course, I wanted to make sure I talk to y'all about in terms of just real estate is always going to be about home buying, right? So, home buying is kind of my bread and butter of my business. I work with primarily home buyers and then, of course, sellers who want to sell their property and then probably even potentially go off to purchase as well. So, when it's a market like it is, and just kind of to educate everybody right now, no matter what state or county you're in, you're most likely experiencing high interest rates and probably high prices. So the past previous years, 2020, 2021, 2022, you had a lot more flexibility in purchasing because you had much lower interest rates. The interest rates basically dictated how much money you could afford per month. So if you're monthly, buying a $250,000 house in those years with about 4.5% interest rate, you was paying like about 15, maybe even $1,600 a month, depending on if you're like in an HOA or what your taxes might be, depending on states and stuff. But now that $250,000 house payment is closer to about $2,000, which is an extreme jump basically from what it used to be. Now, I've been in the business well before COVID. So back in 2019, when I got into the business, and even in 2018, when I was working underneath a brokerage and I kind of got my start in the business, that's where you see a lot of individuals. Interest rates just kind of vary depending on who the person was. So if you were going into an investment, you kind of already knew you were going to pay 10, 11, maybe even 12%, but you might have gotten like 5.25. I would say maybe not six, but probably 5.25, 5.5 was honestly very common in those times. It just went to a crazy low dip in the pandemic years because they were trying to stimulate, and now the back end of that is now we got really high interest rates. But there's still opportunity, and the opportunity is still out there for people to purchase. And I think it's really just a matter of like changing people's perspective about what they're actually purchasing. So if you go into it thinking you're just going to buy like your dream house and get your dream like payment, we don't, it's not gonna happen. It's not to say it won't, but it's just like it's just not like a thing anymore, right? You have to be very creative, which we'll kind of talk about a little bit later. But what I wanted to break down for y'all in general is going to be one of the first things, which is going to be if you are purchasing and you are or thinking about purchasing, there's going to be a number of things that you need to sincerely work on in order to get to that point. The interest rates are going to be high. They're going to stay relatively high over the next for a couple of months, and they're not probably going to come down. So you need to plan ahead of what you want to do. You can't just sit around and wait, especially if your rent is continuing to go up and your savings is continuing to go down. You're just putting yourself more in a position to always be in the back burner versus trying to get into investing, which 9 out of 10, you guys, if you become a homeowner, your wealth itself increases. So there's value in becoming a homeowner outside of just being able to say, hey, I own a house. Like you get more than just bragging rights, right? So one of the first things people always ask me, this is going to be for my home buyers as well as for my investor people too, but kind of like, what do I need to get started? So I think one of the biggest hurdles for 2023 people is going to be keeping debt out of your personal credit. So you guys probably see online all the time about business credit and so forth. I totally believe in leveraging business credit or something similar to that. Another kind of caveat to that is honestly just getting debt out of your name. So if you have a car payment, if you have any kind of like transferable debt, move it out of your name, move it into a family member's name. Even if it's just for the time being of purchasing the house, you can do that, and no one's going to really ask any questions or take it as a con for you. So if you're interested in moving or you're interested in purchasing a house and right now your debt to income is really high, and we'll kind of break that down a little bit in terms of what does my debt to income need to be, Kinesia, you most likely need to focus on your personal credit and keeping debt out of your name. I think the majority of clients that I've had turned down this year is because not because they didn't make enough money. It was not because and sometimes they even might have had decent credit to get approved. It does not mean you have bad credit just because you have high debt. Technically speaking, you can have really high debt and really high credit score, but you will still not get the loan if the credit, if the high debt outweighs. You know what I'm trying to say? You guys, you have to have all these pieces in place. So one of the biggest things that I try to coach to clients is, when you have, let's say, car payments, for instance, we need to be really strategic about it. And you kind of got to be able to have the conversation with family and friends about transferring that debt. The reason being is going to be because of the high debt ratios, right? Like I said, you could have great credit, you could have great income, but if your debt to income is so high, they're not going to give you the loan. So let me just go ahead and give you guys specific numbers for that. So one of the biggest things is going to be your high percentage of debt, which is going to be around like 43% for like FHA. So basically, one of the good examples that I tried to explain to people is like, let's say you have like a $600 car payment, which with today interest rate, y'all, in the cars, that's actually pretty common. Depending on if you go get a new car, I think I saw something the other day that said like to get a new car, your car interest rate is like 8 or 9%, which is crazy, right? So to say that most people have a car payment around $600 or more is very common. But if you're only making, let's say, $3,200 a month, and it can be gross. So just keep that in mind. If it's $3,200 a month, but your car payment is $600 a month, you might have in your head, like, you know what? Well, I think I might qualify because technically I'm able to pay my rent. My rent is $1,200. I can usually pay that on the first check, and I get paid bi-weekly. So that $3,200 might seem like you're living pretty comfortably, right? You're probably able to put some couple $100 into savings, still make do payments in terms of savings towards your savings, and of course still make payments towards any other bills that you might have. But you might feel comfortable, but what will happen is that $600 car payment, and then if you add on any other credit cards or anything else that you have, that $600 car payment is already taking 18% of your debt. So that's almost half. You guys get what I'm saying? So if you add on a house payment, and your home mortgage is most likely going to be higher than your rent. Don't let nobody lie to y'all. It's technically going to be higher if you want to live relatively similar in terms of style and aesthetic of what you already have. And I will do my best, y'all, to like answer any questions or anything like that as we go through. So if I'm losing anybody or confusing anybody, just let me know. I won't add anybody probably until the very end, where I will, use a little bit of time towards answering y'all questions or anything like that. But I just kind of wanted to break down that example of like, if you're making $3,200 a month, your car payment is $600 a month as well, you're already eating up almost 50% of your debt to income that the lenders will approve you on. So just if you are someone else, and let's say your numbers are slightly different, you are just going to use the reference of 43% of your income. You cannot have go towards debt. And debt would be anything like credit cards, car payments, loans, anything that is basically tied to your credit. It's not going to go towards your rent payment. It's not going to go like the numbers that you'll use to calculate. You're not going to use those numbers. You're just going to use things that are like tied to your actual credit score. So technically speaking, rent wouldn't be one of those, but you can definitely use your car payment, credit cards, any loans that are in your name. If you don't have any of those things, the more the merrier, because it increases your chance of being approved. So that is one of the biggest questions that people always ask me is like, Kenisia, how do I calculate my debt to income? And knowing that I'm within like the threshold is just simple math. Use the gross income that you're making per month, and you're going to go ahead and divide that by how much actual, and you can just subtract it in terms of how many debt payments you're making per month as well. All right, so one of the next biggest things that I always hear people talk about, and I won't spend too much time on this because I do talk about it so much, is going to be credit card utilization, you guys. Again, I hear it a lot. I hear it so much. And this is really important why you should work with a real estate agent. The real estate agents are there to help you save money, kind of go to bat for you, to understand your needs, and kind of be like, they're there to be like, if you were the person who did real estate every day, they're basically there to be that person. Like they're there to represent you. So having a realtor there, you should not feel like your realtor is there to just make money and head out the door, or like have, like, a lot of times people have built up this very negative connotation with real estate agents. And in all seriousness, the real estate agent is there really to support you. If you don't make it across the finish line, neither do they. So I've yet to find a real estate agent who is not working, at least in their heads, in the best interest of their client, right? They may not, everybody got different strokes for different folks and different judgment, but they are thinking that they're doing the best for their client. So one of the things that I always try to talk to people about is talking to your real estate agent first and your lender first before you get anywhere started. Y'all, the market is too stiff and too tight to not be working with a real estate agent. So if interest rates are already high and prices of houses have not come down, you need to be working with a real estate agent to find every single program and to vet out all of your finances before you start the process. Even today, I spoke to somebody who'd already lost thousands of dollars because they did not work with a real estate agent prior to going under contract for a house. A lot of that can be avoided when you work with a real estate agent. One of the person's comment that they said was that they went to a new construction office and that the they felt like the real estate agent was only there to they can't even negotiate the price. The price is just one thing, y'all. You still have so many other factors included: escrow, or some counties or states or whatever you call it, earnest money. You still have getting through the underwriting process. You still have appraisal. You still have inspection. You still have so many other components outside of the price. So to think that your real estate agent is only there to do one or two things is crazy. And that's how people lose money. So before you even get started, one of the biggest things you need to do is you need to make sure that you talk with them about how much debt you have. So if you've already kind of took into consideration, you know what, I know I might be really at the tip of that 43% that is going to get me approved for my first home buyer's loan, or FHA in better words, then then you might want to go ahead and discuss that with the real estate agent. When you apply for a loan, the lenders are going to do a number of things. They're going to try to figure out how to get that loan amount down, y'all. They're not going to go into the business of just like, hey, at the end of the day, you don't qualify for this loan. Sorry, kick rocks. They're not going to do that. Instead, they are going to focus on trying to figure out how to get you to getting approved. It's much different than buying a car. Much different, right? Or even going to really get any kind of loan nowadays. They are there to assist you to get to the marker. They're not there to just be like, oh, too bad, never mind. They're going to give you pointers, and as long as you stick to those pointers, you're going to be fine. So one of the biggest ones that I find is clients always telling me, okay, well, I know I have some credit cards. I need to pay my credit cards down before I start this process. That is that's personally for me as a real estate agent, that's one of my biggest pet peeves. And the reason it's one of my biggest pet peeves, y'all, is because how do you know how much money you need to pay down on each credit card to get you to the marker that you want? If you are just solely going off of, you know what, I want to, pay down my credit cards because that's going to make me feel better. Okay, sure. But if paying down a credit card that, you just got in your name, that might not even move the market, right? Because the credit is so new. You need to focus on what the lender is pointing to you, and it's going to be usually credit that is aged over a certain amount of years and usually over 30% utilization. So let's say you got a bunch of credit cards and all of them are right at being used of 30%, meaning if you got a credit limit of $1,000 and you're only using upwards of $300 on one of them, then no, we're not gonna say common sense, y'all, but if you do the math, then you know that you're right at the 30% marker, right? So that's okay. Most of the time, that is actually helping your credit and showing that you know how to pay your bills and that you can handle healthy debt. There is a such thing as healthy debt, y'all. So one of the biggest things that I talk to clients about is like, please don't go trying to figure out which credit card you should or shouldn't play with. A lot of times the lenders have a specific stimulator, is what they call it, to go in there and double check. All right, I need you to pay this credit card down. I need you to pay this credit card down by this much. And that way it helps you save money. I've talked to a lot of clients that feel like they've paid like couple of $100 or even thousands of dollars. And now, when it's time to actually go under contract for the house, they spent that money on the credit cards, and bringing that number down didn't really actually help them. So that's where I'm just like, you guys, you really, really, really want to talk to the lender first. Because, in all honesty, you could be saving yourself a lot of money. And that money can be used for the house, or it could just be used to keep in your pocket. But if you have credit card debt, the biggest thing is really just knowing that it's close to the 30% utilization. And if it's above that, then you need to work with the lender to kind of work on, okay, how do I, get it down to help boost my credit score? So that's the biggest piece I will find about in today's market, y'all. And we'll kind of, like I said, we're going to transition into a little bit more deeper stuff in terms of investing here in Atlanta. But in today's market, For just a general home buyer, you need to keep in mind that interest rates are going to stay probably high over the next several months, probably even flowing into the end of the year, and that home prices ain't budged one bit. So, in order for you to get approved for a loan, especially a loan that you actually want, you need to keep your debt utilization down and you need to work on your personal credit. The best way to do those things, like I mentioned already, is you want to make sure that you get certain things done, such as moving car payments out of your name. It can even be temporarily, like I mentioned, it does not have to be there forever. Technically speaking, if it's out, if you move it to a family member's name, like the actual loan, or put it in someone else's name and it's no longer in yours, you can still be making payments to it. That's fine. They just need it not showing up on your credit. Very, very simple. Where you spend your money after your bills are paid, that's not necessarily the lender's problem. They're more concerned with what's in your actual name, right? Because they have to approve it based off of how much money can I show them bringing in, and how much money do they actually are they forced to take out. They want to know how many people, how many debt collectors are in line. They don't really care if you got to pay, your cousin every month $250 a month to pay the car note, or 600, whatever the case is. They care about what's in your actual name. So keep that in mind. A lot of people have these really high car payments, but if you are going to go purchase a house, you want to move that out. The other thing that I mentioned, of course, is talking to the real estate agent before in terms of utilization, y'all. The the lower the better, but you do not have to pay these things off. You want to hold on to the money because you're going to need the money when you go purchase. And then, of course, just the last few things, y'all, you're going to probably want to work with credit repair. If you know you're in the fives or even low sixes, it's okay to spend the money on credit repair. Just make sure it's someone like valid and credible, right? You want to remove as many collections. I noticed that clients who have more than two collections usually don't get approved. So, if you have more than two collections, or bankruptcies within the last 2 years, you pretty much got to wait. Same thing with late payments. Clients that have, I will say, is usually you can actually have more late payments, more than two. But if you start to get well over, like I will say, probably like 7 to 10, then it's a big issue, and I've yet to see clients get approved. So as like I said, the interest rates keep going up and the prices stay pretty high, lenders are giving out less money to those who they feel like fit the mold. And those are the things that you need to keep in mind, everything that I just mentioned. Hope all that makes sense as we move on. So, one of the big things that I want to talk to y'all about for home buyers, and to be honest, you can kind of look at this in a twofold way in terms of if you are going in as a home buyer or just as an investor, because I'll kind of discuss with y'all how I think it works. If you are thinking of purchasing a house as a home buyer, it's important to kind of think of it a little bit more in this, market as an investment, because you really need to be very drilled in on the numbers. If you're just going out trying to home buy because you want something pretty and you hate working with your landlord, it probably won't work out as much. You need to be very motivated. And I find people who are more motivated to be investors because they see the bigger picture. So put on your investor cap and kind of think more clearly about what are your goals for purchasing real estate. So one thing that you guys have seen me post, and I just wanted to touch on it on here, is going to be the 1% down program. So it's very simple. A lot of people are asking me like, what's the name of the program, or what's the, you guys, loan programs very rarely get named. That's more like a down payment thing. So if it's called a 1% down, they just call it 1%. If the program is about being 1% down, they just call it 1% down. The reason I think you guys are asking the question of, okay, what's the name of it, is so that you can go research it and vet it out. But there are multiple different lenders who are offering this, you guys. So when it comes to a home loan, no matter if you go FHA, if you go this 1% down program, which is technically a conventional loan, if you go USDA, like I recently posted, there are multiple different banks, credit unions, and mortgage lenders that offer all three of these products. You are not going to just find one lender who just offers it. They offer it with different terms, though, right? Some will have higher interest rates, some will have lower interest rates. Some will ask for more money up front. Some will ask for less money up front. And then some will have different things, what they call overlays, meaning, hey, we all offer FHA. The credit union will offer FHA, Bank of America or a bank will offer FHA, and the mortgage lender named John will offer FHA, right? But each one will have different overlays or basically things they add on top to get you guys approved. So one will say, hey, I need a 680 credit, I need a 640 credit. The other guy says, I only need a 500 credit. They will all have different requirements. The guy who wants the $500 or 500 credit score, they might be asking you guys more specifically, like, okay, if I'm giving you a credit or giving you a loan with a 500 credit score, you better not have no collections on there. It better be just because your credit is new, basically. So you better have no collections. You better not have no old, no late payments. You better not have any high debt. They might ask for a lot, and we're going to add some extra points, which means it's actually going to be pretty expensive for you to get this loan. Versus the guy who says, hey, as long as you got a 680 credit, I'm okay if you got a couple collections. I'm okay if you got a couple late payments. And, we actually do 45% instead of 43% in terms of debt ratio. So it's a lot of different, what they, like I said, overlays that are added on top, but everybody's offering the same thing, FHA. They just add extra things on top of that. Thank you. Thank you guys. I appreciate the comments. So I just wanted to kind of break that down because I know a lot of people are like, well, should I go apply here, here, here? It's like, technically, yes, because they're all going to offer different things and they all are going to offer it at a different cost. I'll even give y'all a better one. Y'all know we can go buy a Toyota pretty much any damn where, right? You can literally drive up to any car lot and find a Toyota anywhere. But depending on, you could probably find that same Toyota with different terms in different states at different places. That's the same thing with the mortgage product. You are still buying the same car, the same amount of miles, same color, same all of that, but they're all having different things. Job history, this is a very, very good question. Job history is a little bit, that's why I didn't mention it here, because the two biggest things that I find people not getting approved for a loan, y'all, is having high debt because they got huge car payments, which if you ask me, y'all need to be driving the 99 Honda, okay? There is a reason why you drive around Buckhead and everybody got a Prius, okay? Because the car payments, it's eating up your lives, if you ask me. But whatever. In terms of job history, and then the second thing, of course, is going to be having a lot of like derogatory stuff on your credit. So those two things are the biggest things that I find people not getting approved for. So if I can assist in you guys not getting, and coming to the table a little bit more prepared, those are the two biggest things. Job history. And because this is a recorded call, let me tell you, job history does not weigh as heavily. The biggest thing that people are concerned with is if you own the company. If you own the company, they want you to have the company for at least 2 years because they're trying to verify that most companies fail within the first year, right? So I got to make sure that your company gonna be here, years to come. So that's really the biggest thing. Just think of it in common sense terms. Would you really want to loan somebody money who just opened up a business? Versus loaning somebody money who has been in business for years. It's a little bit different, right? What I would say is if you have just started a new job, y'all, that's totally fine. We don't even need the pay stub. We just need the offer letter. If the job is, or the company is owned by your cousin, auntie, uncle, blah, 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 again, as long as it's not necessarily you being the owner, and you're just an employee and you're still getting a W-2 and a pay stub, you're pretty good to go. You do not have to be on the job a certain amount of years or whatever. It's only if you are self-employed or you are the business owner that is a big concern. So keep that in mind. And I think someone just asked me another question. I'm just trying to keep up, y'all, because like I said, I have both going at the same time. So and that's why y'all see me looking up and down too. I got notes, I got all this going. So how do you transfer your car payment to someone else? The biggest thing is it's not you're going to transfer, you're going to basically have to ask them, and you're going to have to ask them to take over the loan. Technically, you can do that with the house too, you guys, just to kind of keep it in mind. Loans are usually transferable. They just have to be approved for the loan just as much as you were when you got it. So even if, let's say you paid down half the car, now you want to buy the house because your car payment is very nice, or is very, excuse me, I'm reading the comments, but because your car payment is very high still, but let's say you've already paid down a huge portion, you can honestly still transfer that. The other person, whoever the loan servicer is, the person who you pay the loan to. So, not to put y'all all in my business, like my car payment is with a bank called Ally. So as long as Ally don't mind me switching who paying the bill, they just want their check. They don't really care, you know, if if it's Kinesia paying, they need somebody paying it, right? So very simple, very and you can reach out to your servicer to say, hey, I want to transfer this to my mom. Like, great. If you're married, here's another really key point that I want y'all to understand about transferring debt to different people. If you are married, you can use FHA or a lot of these like first time home buyer loans separately. So you do not have to go on the loan. Both of y'all have to go on the loan unless you need y'all to. The only reason you would need to have both of y'all on the loan is if you both needed to use your income. But if one of y'all makes like 120 a year and the other one really only makes like 30 or 40, or maybe she's a stay at home mom. Y'all don't need to be both on the loan. Technically speaking, the one who's stay at home mom won't even get approved, right? Because she doesn't have income coming in. But what I'm trying to explain is in order to kind of like better use these resources that are out there for you guys, both of you guys can hold off on using your first time home buyer loans and programs by just going one at a time, right? Of course, your income needs to be there so you can purchase the house you want, but you don't have to have, just because you're married, you don't have to have both of y'all on the loan. And the person who doesn't go on the loan can still be on the deed. So I can still like, they're not gonna just run off and be like, well, this is my house. That's not it. They still are technically going to they're still technically going to be, on the property. They can still be an owner on the property, just like your kids can be, or your family, or your parents, or whatever. But they don't have to necessarily be on the loan. No, your credit score is only qualifying you to show you that you are a qualified individual for the loan. The income piece of it is going to be the biggest thing. So let's say if you are somebody who's struggling because you're like, you know what, I need a higher purchase price, but I only make so much money. The biggest thing y'all need to do at that point is really trying to figure out, how do I get a lower interest rate? Because that's really the only flexible thing that you can do. So I'm gonna kind of go back into that 1% down program in a second. But to answer that question, you guys, is in the event that you are trying to kind of figure out which one you should do, out the credit score you want to keep as high as possible. That's great. But the actual income piece, if you can't change it or you can't necessarily make more money, I mean, what you make is usually what you make, right? You want to try to bring down the only other variable, which is going to be the interest rate. So the lower I can get the interest rate, the more higher my purchase price. So like I said in the beginning, if I were to buy a house in 2020 and 2021 for $250,000, my monthly payment was like $1,500. Boom, we doing that all day. Now that 250, let's say even closer to 300, if you get approved with interest rates close to almost 7, that payment is almost like $1,900. That's like really expensive versus that 15, right? That's a $300 to $400 minimum jump. So that's how you can kind of get it down, and you can do those drops in interest rates by using like money that you already have, maybe tax returns or money that a family member might give you to pay down your interest rate. So that is a variable that you can control, is the interest rate. You can buy it down, y'all. There's opportunity out there to bring you down. And then there are programs out there, especially with people with high credit scores, to bring it down. So the higher the credit, great, because you might have a lower interest rate already, but then you can use money, because money talking, We all know the phrase, right? So that's just one way. The other big thing, you guys, is with the 1% down, there's no PMI. So there's something called private mortgage insurance. If you purchase a home, usually, especially like FHA or VA, and these government backed loans, there's a certain amount of it that is just interest on the loan because it's a risky loan because you're a first time home buyer. I don't know you. I don't know if you're going to be able to pay this back. So they add just extra money on top to make themselves feel better at night. That additional money that they're adding on top, technically speaking, that money is not included in that 1% down program that I recently posted about. So if you're interested in purchasing upwards of 350, and in my opinion, y'all, I sell real estate. I look at houses all day. I see nice 350 homes. Are they smack dab in the city? If it's a single family house, no. You probably gonna get a condo. You probably gonna get a townhouse. But I still find really nice homes that even I personally, as well as my family, would find comfortable. So this ain't just me, you know, running my chops here. So with that said, those are really good programs where you can probably get the interest rate very fairly affordable and or buy it down with the money you save not going towards down payment, as well as having no PMI. You're looking at a very normal or lower monthly than before, and that helps increase your purchase price for the young lady that was asking. In terms of one of the biggest things that I want to talk to y'all about today is because this market, again, it's a high interest, high price market, especially in Atlanta. I don't know about everybody else, but I will say even home, Tampa, Florida, places like that, but the markets are amazing in terms of like buying real estate and it being a great investment for you. These areas where people are just flocking to. Also, just keep in mind the quality of living around these areas is just great. So people want to live in these places, and that keeps demand high, which keeps prices high. So because of that, there are going to be, or because of the high interest rates and people not getting approved for regular loans, and some people might shoot me in the foot for this one. I want to talk to y'all about non-conforming, non-QM loans or non-conforming loans, right? So if you've never heard of a non-conforming loan, I want to kind of give y'all the formal definition and then we'll kind of go into the pros and cons really quick. But this again is for my home buyers, no matter if you're investing or if you're going to be first time home buyer, wherever you are. And this can be used in multiple different states and it can be used with different lenders. You just have to find one who offers this. But this is a great program, especially for people who are not getting approved or not getting approved for what you want or don't really have the documents, all that good stuff. This is what you guys want to invest your time into, and you want to work with a real estate agent and or a lender who is able to help you with this. So, what is a non-QM loan? A non-QM loan is a loan product that doesn't conform to the lending guidelines set by the Consumer Financial Protection Bureau. Non-QM loans are exclusively designed for home buyers who can't conform to stringent requirements for a qualified mortgage. Real estate investors, foreign nationals, self employed individuals, and credit challenged people may find it challenging to qualify for a conventional loan. This is where a non QM loan can be helpful for enabling borrowers achieve their dreams of home ownership. So I hope y'all was paying attention to that very formalized definition because I'm going to go through the pros and cons of it. But again, this is for people if you are a foreign national, real estate investor, home buyer who is self-employed, or someone who's very credit challenged, you might want to listen up because this might be the loan product that is going to be best for you and your family if you're trying to get into real estate probably between the next year or so. I don't know beyond what the next year is going to look like, but let's just say if it's anything like the past year, I think you should plan ahead and go ahead and try because just re-signing a lease and hoping the market is going to shift in your favor is just kind of weird. It doesn't really seem like you're planning for anything. If anything, I would try to at least vet out one of these products, which non-QM loans might be something of a good option for you. So let's start off with the cons and then we'll roll into the pros for it. So one of the, because I think if you're going to go into something like a non-QM loan, you need to know the risk associated. So let's just talk about that first. It's going to be higher interest rates. And you're probably like, Kanicia, that was the whole reason why I didn't want to do the other loan. So how does that make sense? The reason this one will be a little bit better though is you still technically might be able to use buy downs and so forth, like using your actual cash. So people who are very cash heavy, who kind of, let's say you do work for yourself, but let's say you make your money through Cash App, Venmo, whatever, you know what I mean? But it's not necessarily like W-2 employee type of vibes, then you can use the money towards buying down interest rates. So just because there is a higher interest rate, that's a con, but you can work through that and you can always refinance. So, okay, yeah, I'm paying high interest rates for the next 1 or 2 years, but shortly thereafter, I'm good. And I've already grown equity in the house. So, high interest rate, but being able to get qualified for the house, great. Points and lender fees are very expensive. So, again, if you're gonna purchase real estate or just go into any kind of investment, you gotta be aware that at the end of the day, it's gonna cost to be the boss. So higher interest rates and or not even just higher interest rates, but the points, basically the fees that they will charge you to obtain this loan are going to be higher. You may need a larger down payment. So this is not necessarily for people who I would say who are income challenged. This is for people who are credit challenged. So like I got plenty of money, but I don't got the credit. Or I got plenty of money, maybe my credit is decent, but I don't got it all on paper. Again, this is where a non-QM loan is going to be probably a better bet for you because they're not going to be holding you to the gun as much as a conforming loan or a traditional loan. Honestly, there's no average cost that I've seen, but I will say for most of my clients, upwards of around like, I had one client who purchased a house, and this is for the young lady who asked what is the average cost of buy down points. I saw someone close to a half a million, or it was a $500,000 house, and they needed like $8,000 towards the buy down, but that was on top of their down payment, so it wasn't cheap. But we were able to ask that from the builder, so they didn't really have to pay that much at all. And okay, in terms of the non-QM loans, you guys, it's going to be a loan product that is technically speaking is going to be actually very not to say hard to find, but it's not going to be a lot of people who offer this. So, and you want to be careful because it is very risky. So you want to probably go through someone you trust. And then the pros, y'all, just the pros about non-QM loans is this can, of course, like I said, help home buyers who are not qualified in the traditional sense. Unfortunately, like mortgage lending is still very like, do you got a job? Do you got income? Show me your tax. Like they're very still like traditional. So if you are someone who's making money in a non-traditional sense, or you're trying to maybe even go into like investment deal, whatever the case may be, and you are like I said, very cash heavy, but you don't necessarily have credit or you don't have it on paper or you're a foreign national, whatever the case, and you can't get qualified, this is the program for that. You will still need to show something though. So like you might need to show like a bank statement, but to be honest, with the non-QM, they have a lot of different things outside of just the bank statement loans. And then there's also going to be very flexible terms. So, like I said, you might have a higher interest rate, but you might be able to negotiate on other pieces that might get you approved for a higher purchase price. And then, of course, even if you have like negative things on your credit, all that good stuff, you technically will still probably get approved with a non-QM loan because of the risk that is there in terms of higher interest rates. So I hope that helps in terms of an extra product. I'm just going to answer a question. Can you use FHA to buy one house after you have sold the first one? Yes. So y'all, technically speaking, FHA loans is not really just, we all use it to say first time home buyers so that we don't confuse people, but technically it's just it's FHA. It's not really a first time home buyer loan. Like it's really for people who, if you haven't bought, I think within like the last and I might have this wrong, y'all, but I think the last couple of years, you still can get an FHA loan. So, or if you just sold your house and 3 years later you're ready to buy again, you can go back and use your FHA loan. The thing is, usually by the second house though, you might buy more. So if your FHA loan, most places like it's only gonna reach upwards of like 480, I think here in Atlanta. So by your second house, you might be buying a little bit higher than that. So just keep that in mind. If you are thinking of using the FHA loan over and over, technically speaking, you might want to end up going higher. But that kind of leads into my next point, you guys, of this whole thing, which is going to be the investing piece. And I'm going to kind of go a lot faster through this piece because I am going to have a separate like presentation or seminar about home investing, but I wanted to make sure that we kind of like took some time and really talked about being a home buyer and buying in this market, like I said. But one of the biggest things that I think people are not taking into consideration and why they're kind of stagnant about buying this year is because they're not looking at it as an investment. Although interest rates are high and things are not as favorable as they have been over the past few years, in terms of just getting a house, the big old house on the hill, you still need to see real estate as an investment. And if you see it as such, you'll know that you can still buy in this market and still make away with a really good investment. So, the first thing I want to talk to y'all about is house hacking because I know everybody knows the term house hack, but kind of one of the biggest things that I wanted to break down to you guys in terms of why house hacking makes so much sense and why I think it's just so important for individuals to house hack or think about house hacking first, especially if you are someone who is single, young, basically have a smaller family to deal with. House hacking is like just going to be like the make the most sense in terms of purchasing, especially if you purchase this year. I think if you go into it think you just going to get your, like I said, your dream luxury house on the hill, you're going to set yourself up for more of a fail. So everybody knows like house hacking as the kind of traditional story of, okay, I'm gonna go buy this duplex and I'm gonna live on one side, I'm gonna rent the other side out, it's gonna pay for the mortgage for the both of us. Life is great, right? And at the end of the day, y'all, it sounds super, super good. But with prices still being high and interest rates still being high, 9 out of 10, that duplex, triplex, or whatever that you can purchase and live on one side and rent out the other side and make all this money, it's probably really expensive to buy if you want a really nice one. You're probably going to have to like drop down in like quality of living. So like ain't no stainless steel appliances in your new spot. Even though you own it and it's your spot, if you house hacking, it's probably not going to be the best. And I find that in both markets. Like I said, I work primarily in Atlanta, but I'm also originally from Tampa, so I still keep my eyes and ears to that market and work in. And so these are two really strong, good markets to invest in. And at the end of the day, you're not buying like a duplex or any multifamily that is just like brand spanking new, amazing without spending almost $500,000 plus. So if you, and technically speaking, if it's your first property, like I said, you go FHA, you're not buying over $500,000. So you're kind of stuck in this, rock and a hard place, right? So the biggest thing you want to kind of take in consideration though is you are going to get a decrease in like living, but it's still possible. You just need to keep in mind that it's going to be for a short time. So you have to stay technically in the home for a year. Like I said, if you're someone who's single or this and that third, it's a good investment to do the house hack because that first year or two is going to be well worth it for year 3 and 4 when now you're cash flow on both sides. You can use equity out of the house to go buy the next thing. Boom, you're on to it. So I won't go into what everyone already talks about in terms of house hacking. What I want people to kind of take in consideration is if you are, let's say you have a larger family, you kind of need that full 3 bedroom, 2 bath. So you're not going to do a duplex. You're not going to do that. You're just going to buy a single family house. But you end up getting only approved for maybe even a $300,000 house max, right? Maybe even a 275. You looking at the houses, you like, oh, they all right. I'm not a fan. I want to go higher. I want to go higher. Keep this in mind. Make your first house, and this is where I would say think of house hacking more as no matter what you purchase first, that is really that's your first house hack. It doesn't matter if it's single family or multifamily, you just need to make sure that the first house is going to be an investment property. Because when you get ready, let's say you did the opposite. You bought the grand house for 475. It's amazing. You love it, all of this stuff. But how the family still gets bigger, or you decide, you know what, I want to buy an investment property. This is where the house hack people are already one step ahead. They can go back and go get a loan that is FHA, right? They can go use that 1% down. They can go use the 3.5% traditional. They might even qualify for a 0% down, because now the people who did the house hacking and they kind of sacrificed that year to 2 years, they're able to go buy their second house and call it their primary house. You, on the other hand, if you buy your first house, it is so amazing and it's so nice, and then you decide to go buy your investment house second, you kind of limited yourself, because when you go buy the second property, you guys, and you go into the idea of investing, you're going to have to put down a crazy amount of cash. I'm talking nothing less than 15%, probably upwards of 20% down to buy the investment property. As soon as you tell the lender, oh, yeah, I already own a house, that's where we primarily live, but we want to go ahead and get into real estate now, like in terms of being landlords or and so forth, or buy the duplex, they're going to say, great, I hope you got 20% down. And like I said, most of those places, if you want to buy a decent one, you're gonna look at anywhere between anything probably above like 320, 350, upwards of like half a million. In terms of like a duplex property. If you're looking at any of those, you now have to put 20% down. Versus if I was, like I said, if I'm able to, make it work for a year or two, I bought the first house, it was like 250, 275, but that's fine. I only put down 3%. It was good. My realtor got me a closing cost paid. But now I want to go ahead and rent this house out and I want to move to the next house. Guess what? My income didn't really change, but I can use the money now from the first house to say, hey, that's actually going to be my investment house. The lender is going to say, okay, and now I want to buy my primary. Let's use the same loan. They're going to say that's fine because that's your primary house. So your difference between the two is the person who kind of sacrificed that 1 to 2 years, y'all, and I don't want to say sacrifice because I feel like people might get deterred from that, but the people who focus on, you know what, go ahead and get the lower price house or go ahead and kind of compromise on the first house, use that later on to be the actual investment house and technically think of that house as the investment house rather than buying your dream house and then trying to get into investing later. It's going to cost you more money because you can't go back now and say, hey, the investment house is my primary. So it means a huge deal when you are investing, y'all, in the house hacking kind of mindset, that your primary house is purchased relatively, I would say, cheaper, and then using that money to go ahead and purchase the second house that could be a lot nicer. So to me, house hacking is a lot more of a scalable thing than it is buying your really nice house or even a really nice, super expensive duplex and then trying to go get something else. I think it's a lot better of an idea, y'all, to focus on the different loans. If you purchase an investment loan, you're putting 20% down. So, and there's no way around that, right? If you purchase a second property, 20% down. If you're always purchasing your primary, wink, wink, quotation, quotation, if you're always purchasing your primary house, you get what I'm saying? Every time you're like, oh, well, now I want to just turn this into the rental. Oh, I just want to turn this into the rental. If you're always saying that and you're always able to show, no, I'm going to turn the next house into the primary house, you're only putting 3.5% or less down. I hope that makes sense. So that was my spiel on kind of like why so many people can, how and why so many people can get into investing in terms of house hacking. So to continue and to wrap this up, you guys, the next thing, and this is really what's going to be on my next one. So I want you guys to keep in mind anything that I'm discussing on this call. Feel free to go ahead and schedule a consultation. DMs is cool, but I'm probably going to tell you to just book the consultation because that's where I get on the phone with clients and kind of like break down specific to their scenarios. So based off of how much money they have and so forth. So the consultations are always available. They are free and they're 15 minutes and they're in my bio on my Instagram at Kiano's Luxury. So make sure you go in there. And the last thing I wanted to touch on, you guys, in terms of for those individuals who are looking to get into Airbnbs, who are looking to do rentals, who are looking to do fix and flips. This one is going to be a very big one, especially as, like I said, same thing for home buyers. You guys are looking at a very high interest, very high price market, right? Especially in these really good ones where you want to invest in, you're looking at these really high prices. So the number one thing that I need you guys to think of, write down, and get ready for when I do the next investment one specifically is going to be creative financing. Creative financing is going to be the biggest thing going forward over the next few years, in my opinion, because the more people can't get approved and the higher the interest rates might possibly get, or how, depending on how much they even stabilize at, there's still going to be a lot of people who are not able to get approved for it. And in order to get into these properties without paying the 20% down and paying the super high interest rates, creative financing will be the biggest thing. So there are a number of different ways to do creative financing. The two that I would say, you guys want to focus on is going to be for my investors, especially people who are maybe, like I said, thinking of doing Airbnbs, people basically who want to hold on to the property and cash flow it, as well as people who are going to do fix and flips, is going to be seller financing. The seller financing is probably something you guys have already heard before, but a lot of people are getting more open to it for the houses that are sitting on market because there are less buyers out there now, right? Before, the ugly house would sell off the shelf fast. Now that same ugly house is unfortunately still sitting. Now, the prices of them are still relatively high because they have so much equity in the house. They can still price it fairly well, but they may not have as many buyers knocking at their door. So, if you are someone trying to get into investing into real estate and even wholesaling, to be honest with you guys, seller financing is going to be one of your biggest pitches. So, what you'll do is you'll reach out to a agent who's either representing a seller or to the seller directly, and you're going to basically explain to them like, hey, I know I can pay back a loan to you. I want you to basically hold the deed to the, I'm going to hold the deed to the house, or I'm going to hold the deed to the mortgage. You're going to hold the deed to the house, and I'm going to pay you. Most of the time, sellers are already motivated to move. If they list their house on the market, or even if they post it on Zillow or whatever the case may be, they are motivated. They gotta go, right? And they don't really want the obligation of trying to rent it out and maintain it or any of that. That's where you can come in with this pitch of seller financing. So they're not going to check your tax returns. They're not going to check, a lot of bank statements. They're just going to ask, do you have the cash? What terms are we going to agree to in terms of how much you're purchasing for? And then what interest rates, right? So if you're like, well, I don't want to pay a really high interest rate, I heard seller financing can be high. There are ways around that. So a lot of times you can even do a upfront payment of the interest, so that way you have a no interest payment loan. That is something that is a little bit more creative and takes a little bit of detail, but these are opportunities for people who technically, if you have a lot of cash and you don't really want to go through the traditional financing, that's one. And then the second thing that I want to discuss with y'all, and this is where I'm going to have a full blown like live one. So the next one, you guys, I'm going to try to do in the next 2 weeks. I'm going to actually have a real estate investor on here, and we're going to kind of break down the subject to. So go ahead and write this one down if you have any pen and paper, because this is going to be really important. If you are someone who's looking to either do wholesaling, Airbnbs, anything like that, where you do not want to use your own personal credit, especially you do not want to have to show any documentation, subject to is going to be super, super lucrative for you. Subject to is very similar to seller financing. The difference is instead of us even coming up with our own terms, because let's say there's still a mortgage on the house, subject to means I am just going to basically now take over the loan. So similar to how I mentioned the other day about transferring the loan, no, we're not going to transfer it, but we are going to take over the loan payments and be responsible for the payment. So technically, it's going to be two people on the deed in terms of who the deed holders. So you're going to have someone basically who is going to be the deed of trust. So usually that's your lender, Bank of America, Wells Fargo. That's usually the deed of trust is usually held with them because they're the people that you basically are paying back. Now you're going to have two people because technically speaking, the seller's still going to be on there and you're going to be paying them as well. So you don't have to go through your credit. You don't have to go through all these different things. You're basically able to acquire the property, have the deed in your name. Yeah, that is a really good point. So technically, yes, subleasing, but for a house, y'all. Okay. So I think that is like, for someone who's been in this business now for a number of years and seen a lot of transactions on, seller side, buyer side, investing, this is going to be a game changer. And I'm excited to see hopefully how it can change real estate in a positive way and help kind of get more people involved. Yes, so I love that. Well, congrats, girl. I hope you make it through. Hope to see you on the other side. But yes, it's technically like subleasing. That's a really great way of explaining it, you guys, because you are literally taking over their mortgage and but you're still taking priority over the property. You're able to do what you want with it, whether it be rent it out, own it, whatever, all those good things. So I hope you guys got some really good information from this. Like I said, I'm going to have an actual real estate investor on the next call. I'm going to try to maybe even get two, but let's see how that goes. But I know for sure I'm going to get one on here to kind of break down all this stuff for y'all because when it comes to creative financing, it is definitely going to be the way of the future. It's still going to, for my real estate people, it's still going to involve us. We do not go away. I don't care what nobody say. Real estate agents are needed. I always tell people, I don't sell $100 million houses just yet. But let's say I ran into $1 million or $100 million tomorrow, I'm still using a real estate agent. It's just common sense. And you need someone there to support you and represent you. It's just helpful to have that. So with that said, this creative financing still involves pretty much all the same players. Closing attorneys, title companies is still very legal. It's not, just some wild, wild west stuff. It's very important, but it's giving you guys the tools to kind of hop in. We kind of touched on pretty much everything else in terms of the home buyers, non-QM, um, basically your debt to income ratios, how to transfer your debt out of your own name, working with your spouse in terms of who's going to take on the loan first, who's a better person for that. We touched on a lot of good stuff. But if you have any questions, y'all know to hit the DMs, hit the link in my bio. Go ahead and book that 15-minute call. It's free. It basically just helps set up our relationship with one another so that way we can chat. And like I said, I will be back here in 2 weeks' time, maybe 2.5. I might space it out a little bit, maybe 2 to 3. And I want to have some investors on here so we can really dive into creative financing and help y'all get y'all first deal on a contract, whether it be for wholesaling, building, flipping, Airbnb, all of that. We will be able to kind of dive into that from people who are doing it in the business right now. So peace, love y'all, and I hope you have a great day. Bye.